Stocks and bonds are the basic building blocks of most investment portfolios, but they can greatly differ in the level of risk and reward and how they perform under certain market conditions. So what's the difference between stocks and bonds? And are there times investors should focus on one asset class over the other? On this IBD Explains, we ask, what are bond basics investors need to know? And here with me to help break things down is IBD's personal finance and management editor, Matt Krantz. So Matt, tell us about bonds. What are they and why would an investor want to purchase them?
So bonds are basically IOUs. It's a way to borrow, to lend money to a company or another issuer with the promise that they'll pay you back. But there's a catch that's good for you as the investor. You won't want back just what you gave them. You want back plus interest. And that is where bonds get interesting. It's that return that you can get, and it's pretty safe because they're supposed to pay you back.
And can you tell us a little bit about the difference between bonds and bond funds? And are those similar to mutual funds and how they work?
That's the key question. So there's two main ways to invest in bonds. You can go out and buy bonds from individual issuers or governments. As you can imagine, that takes a lot of research. I mean, so you have to understand how creditworthy they are, how much they're willing to pay you, how much risk there is. Or you can go with a bond fund. And there's two types. There's active and there's index. So with an active bond fund, you're basically employing a manager to do all that work for you, interview governments, interview issuers, and pick the bonds that they think will be best. Or you can just buy a bond index, which basically buys everything in certain popular bond indexes that track certain sectors of the bond market based on the risk characteristics. And bond funds and bond mutual funds are akin to each other. There's one nuance. There's bond mutual funds, and then there's bond ETFs. And they both have they're kind of the same thing, but they come in different wrappers.
Right. And you mentioned all the research required when you're purchasing bonds. But can you talk about some of the advantages maybe of investing in bond funds that would make them more attractive than stocks?
Yeah, so one popular type of bond is a charter school. So you can have a school in a local area that's firing up, and they think they have a certain angle and they're going to be differentiated. If you're going to buy those bonds, you really need to get over to that school. You need to meet the principal. You maybe want to speak to a couple parents. You might want to talk to some students, see what kind of students they are, get some test scores. That's a lot of work. I mean, I wouldn't want to do that. I've got better things to do with my time. If I'm interested in that type of bond, and those can do well, charter school bonds can do well, I think that's a case where you want to buy a fund where either a manager is picking them out or there's an index that kind of picks them all.
And I think a lot of investors are aware of some of the risks of stocks, but what about bonds? What are some of the things to look out for there?
That's a great question. I mean, people think bond is safe, and they kind of are, but it really depends on what you're buying. So if you're buying a US Treasury bond, a 10-year Treasury bond, it's pretty safe. But let's keep in mind, that's exactly what got Silicon Valley Bank into trouble, ironically. The safest bond in the world had risk of liquidity, meaning the 10-year bonds, their money's locked up in 10 years. So when people wanted their money out of Silicon Valley Bank now, they couldn't even sell for a profit the most safest of the safe bonds. Then you've, on the other side of the curve, you've got junk bonds. These bonds are kind of cool because they pay huge rates of return. You can get 10%, 12%, 15%, but you know what? You're giving your money to some shady operator. I shouldn't say shady operator, but not investment grade operator.
Not the most reliable.
Exactly. I mean, they may very well pay you back, but they may well ask for concessions or ask for different, a break. So they're not investment grade.
Well, I think that leads to the next important question then. If I'm looking at, buying into some of these bonds, how can I evaluate their performance?
Yeah, so the way to really kind of do that, in my opinion, is you have to decide if you want to do all that homework. And if not, you really want to go with a bond fund. They have drawbacks too. They can oscillate in value. You can actually lose your principal in a bond fund, which you can't really do on a bond. But it takes a lot of effort to kind of pick out a bond fund too. Most people, their default is the AGG, which is the iShares bond aggregate. It basically owns every single bond on the planet. And that's kind of a simplistic view. It has a synthetic way of owning all the bonds. So no matter what the bond market does, you're kind of guaranteed to kind of be in the pack and you're going to do okay. and the fees are really low. So that's not a bad way to go. And a lot of people just do that.
And I think a lot of investors would be curious, are there certain market conditions that might make bonds or bond funds more attractive to invest in?
Yeah, there are. So high interest rates are great as long as they're not rising. If they're rising, it kills bonds prices, because if you buy a bond at 5% and you can get one for 6%, your 5% bond's not looking so hot, so that can hurt it. But if rates are stable and high, that's a really great environment. But also it has to do with your own personal situation. So if you're 25 years old, just graduated, you've got plenty of time before you retire, you don't need to mess around with this bond stuff. I mean, you can just go for it with stocks. But if you're 65, 70 and you're closer to retirement, you're going to want the stability of bonds. And it makes a lot of sense to choose a bond fund at that point.
Well, Matt, thank you so much for your insights today. We really appreciate it.
All right, thanks for having me.